Alrighty. Welcome, Twin Cities Jew folk. My name is Genevieve Parker. I'm the community engagement manager with Twin Cities Jew folk, and I'm here with Lewis Engler with Northwestern Mutual, who is going to offer the opportunity for you to ask any questions that you've got about finance, savings, and investment, and give us a presentation. Lewis, please take it away.
Sounds good. So I'll start just a little about myself, but I want to make sure, can you guys see my screen here?
Yes.
Yes.
Okay, perfect. So I'm going to flip through here. I ideally like to make this as interactive as possible. So if some more people join, and people have questions, let me know. For some reason, on my side of like what I'm looking at, I don't see anything in the chat box. So if you want to just interrupt me at any point, if you have questions, just let me know. A lot of this is focused more on personal planning. There's a couple things that get into business planning, but certainly there's a lot that we can cover on the business side of things if people want to, or if it's applicable. A little bit about myself. So I'm a financial advisor at Northwestern Mutual. I've done some stuff with J-Link and TC Jew folk over the years. So that asked me just to give a little bit of a seminar and Q&A of some basic on financial planning right now. Obviously, because there's a lot going on in the world. I'm doing this for about 7 years, and really a lot of the work that we do with clients is helping build a comprehensive financial plan, which I'll talk about a little bit. And then we'll talk about some specifics just of, questions that I'm getting from clients and non-clients and things I think people are curious about. But again, any Q&A would be helpful here, just so we can make this interactive as possible. And it'll be able to, I think you'll be able to view it after. So let's see here. We got a quick agenda just of the basic things we're going to cover today. Basic financial planning, so just things that people should be thinking about and things that we typically help clients think about. Explain basics of investment planning, what happens in market downturns and these types of that are sometimes scary times for people. Some of the basics of life and disability insurance. This has come up a lot just for us as advisors over the last few weeks. So we'll go over that. The CARES Act, which is you probably heard and read some about with the Coronavirus Relief Act and economy support, some of what they're doing for stimulus packages. We'll go into a little bit of that stuff. The payment protection program, so that's more towards business owners, but if we have any business owners that are viewing this now or later, that's an important thing that they're doing right now, and then we'll leave some time for Q&A. So that's really all I've got. Like I said, if other questions come up, certainly let me know. When we start to, talk to clients and just talk in basic terms about financial planning, there's a lot that goes into it, but sometimes we'll separate it into 5 different pieces. So the first one is saving money, which is obviously important. Spending, you're going to spend money. I get the question a lot of like, how much should I save or spend? And that's not necessarily the same answer for everybody. Grow, how do you actually structure your investment portfolio, or how do advisors like us structure investment portfolio? We'll dive in a little bit to that. Protect, that's more on the insurance side of things. So if you have a solid financial plan, you should make sure you have the proper insurance in place just to protect that plan. There's a lot of weird stuff that can happen, obviously, that we don't expect. And so there's some basic insurance planning that sometimes just gets missed in financial planning. And then obviously donating money, giving, whether that's time or money. Certainly there's weight tax incentives for giving money. And I had a couple questions actually about how do people right now balance wanting to still give to organizations or be a part of, be able to pay memberships to their synagogue or whatever it is when they maybe did lose their jobs. So what are some things, strategies or ideas, and just how to maybe think about that differently as well. So we'll go through each of these a little bit more in detail. As a general rule, and sometimes some of you may have heard of this, but the 20-20-60, saving 20% of your income is a good metric, especially when you're younger. The longer you wait, obviously math will tell you the more you're going to have to save. But when people are looking at structuring a budget, that's, I get that question a lot. It's a good general rule of thumb, but again, it really depends on the specific situation and what they're trying to accomplish. Where to put money? Over time, there's a lot of different places you can put money and invest. I think this is sometimes where the school systems is a little bit of a disservice and not teaching us a lot about personal financial planning. I think a lot of times people know they get to work, you sign up for a 401k, and that's about it. It's about what we get taught. So we really help coach clients on different places to put money, so it's not all in the same bucket. When you hear diversification, that can mean a lot of things. It can certainly mean diversification from where it's invested and like what, how aggressive that account might be, but tax diversification becomes really, really important over time as well. And there's certainly some taxable strategies right now that a lot of people are taking advantage of when the market does go down. We can talk a little bit more specifically about that. But what the point of this slide is supposed to show is, depending on where you're saving money, there should be a different strategy on how that money is invested. So there's not one saving strategy that is right for everybody, or even for each individual account or where you're saving it. I'm gonna pause. Any questions on here for anyone so far? I can't see who's all on here, but not. Keep rolling. Okay, so some common questions that we've been getting. So what happens if you have a job change, if you get laid off? What should you consider? I've certainly had clients that have been laid off, and I'm sure everybody knows someone who's been affected in some way. There's a lot of different things to cover here, so this might spark some more questions. But the first thing, maybe not the most important, but the first thing that people forget is what happens with that old 401k or a 403b. If it's basically that a 403b is a similar type of plan, but a 401k or a 403b are just employer-sponsored retirement plans that they allow you to contribute to while you work at that employer. Once you leave that employer, you aren't allowed to contribute to it anymore. It doesn't just go away though, and sometimes people forget that there's real money that exists. So you want to be cognizant that if that does exist, what your options are. There's a few different options. You could sometimes roll it into your new employer plan if they allow you to. Very common, people will actually roll it into an IRA, which just stands for an individual retirement account, or a Roth IRA, which is the same. It's just taxed a little bit differently. And the IRS allows you to do it completely tax-free. And then that IRA you can either manage on your own or have a financial advisor who helps you manage those accounts. But typically it's in your best interest to get that into something else versus just leaving a 401k sit in a previous employer, especially if you end up with multiple 401ks over time. It can make things complicated and honestly hard to track. I've run into many situations where people have like 7 or 8 old 401ks, and finding info and statements on all those things can be kind of a pain. So,
is there a cost to roll over any sort of IRA?
It's a good question. So no, there's no taxes or penalties or fees that you pay. The only cost associated with it would really be depending on what you're rolling it into. If you're buying, it depends on the investment that you're putting it into. So there's no cost that actually you incur just by transferring it. It just depends on how you choose to invest it and really like how that platform works. That might kind of be a confusing answer, but the answer is no. You don't incur any cost, like initial costs, typically for rolling that into something else. Does that answer your question, hopefully?
Yeah, I just didn't know, in this day and age, there are costs incurred with things, or how the transfer, all that goes. So thank you.
Yeah, there's other factors to consider, because when you move money from one account to another account, there could be days where it's not in the actual market, where it's not invested. So if you do move it, but delay the process of like how long it takes to get from one account to the other account, and the market does really well for a week, then you would incur some unintended cost that just of not actually having that market growth. So you want to be cognizant when you're moving them, but there's not like a fee typically that you get charged. There's a lot of other stuff we can get into with 401ks and stuff like that. So we can come back to that certainly at the end. What benefits did you previously have? So commonly, obviously, health insurance. You want to make sure that you're covered on some health insurance plan. Life insurance is a very common one as well, that typically you don't have, or if you're self-employed, that typically you get on your own. And disability insurance is another one. So we'll talk actually a little bit more about those three after. And then the CARES Act, the Coronavirus Relief Act, is actually helping compensate a little bit on top of unemployment. So filing for unemployment if you do get laid off. And then I'll talk about the CARES Act in a second. And then accessing Monday, should say money, there's a typo there. Money in retirement accounts. There actually are some changes right now they just made that allow you to access money in retirement accounts if you need to, without some of the penalties you would normally incur. I typically would not advise taking money out of retirement accounts, but they've temporarily changed some of the regulations. And so typically that is a little bit, they're doing that a little bit more for older clients who are in retirement, maybe need to get access some of that money right now. But if we have questions on that, I can come back to that, because there's a lot that kind of goes into some of those changes they made. So some of you, if not all of you, have probably heard about the CARES Act and this kind of the stimulus package and all that stuff. What that really means is they're giving a refund to individuals. So it depends, what you get depends on your income. So if you are single and you make under $75,000, and they right now are looking at your 2018 tax returns. If you have not already filed, if you filed, then they're looking at your 2019 tax returns. If you're under 75,000 of what's called adjusted gross income, I won't get into the full details of where that number comes from, but that if you had any deductions that you took, that would reduce your taxable income, or what they consider your taxable income. So if you made 75,000, if you made 80,000, but you had 10,000 in deductions, and now it says you made 70,000, that would be your adjusted gross income. So even if you think you made over $75,000 last year, you still might be eligible. But once you exceed that number, then there's kind of a phase out of how much you actually will get from that. You can get a portion of it up to 99,000, and then once you're over that, then you don't qualify for that anymore. Same thing, household. They're just household numbers. So that amount that you get initially, if you're under 75,000 of adjusted gross income, is $1,200, and then it's $2,400 per couple, so you can get that as a couple, and $500 per child. So that was a lot of info in there. Any questions on any of that, or any terms that maybe you use that you're not familiar with?
Lewis, I have a couple of anonymous questions that have been submitted. If you're going to get to any of this later on, just let us know. But the questions are, how should people be thinking about mortgages right now and credit cards right now? Is it smart to refinance, and is it smart to ask credit card companies to freeze your interest rates? And those are the questions.
Yeah. Those are great questions, and I a lot, like I should mention all of this. You want to talk to a professional to get professional advice on some of this. I can just give you some general knowledge on some of it. Yeah, mortgages right now, depending on the rates have been going up and down, and I would actually encourage, if you're looking at refinancing, to talk to a mortgage professional. Because that number has been fluctuating a lot. It may or may not be, it really depends on a specific situation if it depends to refinance. In terms of student loans and credit cards, so there's a couple different things you can do for student loans that you can actually, there's some programs that they've now put in place that you can defer some student loans. aside from coronavirus, I always encourage people to relook at their student loans, especially if you have multiple loans and you're a little bit out of school. Many times you can refinance with different companies to get a lower interest rate. And sometimes that makes sense to do. Sometimes it does, sometimes it doesn't. And then with credit cards, it kind of depends on the situation. It's hard to get into specifics, but it depends on the situation. But sometimes it can make sense to consolidate credit if there's a period of that you can pay it off or you're going to pay it off, because some companies will allow you to consolidate and have like 0 interest rate for 12 months on all of that debt if you pay it off in 12 months, but then after 12 months, your interest rate will spike way up. So if people know that they can pay it off in 12 months, sometimes that does make sense. But again, you want to talk to a professional about mortgage rates, interest rates, student loan rates, stuff like that. Good question. Any other anonymous questions on there? I can't see them from my end for some reason, but.
I think that's it for right now.
Okay. The one thing I'll mention on the CARES Act here, like I mentioned, it uses your 2000. It uses the tax returns that they have for you right now. So if you have not actually filed, and this sometimes is a little bit more common for business owners if they've have an extension or they just haven't filed because they have made exceptions now. Sometimes, now I'm telling you as a recommendation to do it or not do it, but sometimes it might make sense to use your 2018 versus 2019 taxes. So it's just something to think about because they can only use what the knowledge base that they have right now. And those actually are started to be issuing this week. I haven't heard of anyone specifically yet getting them. I think I've heard seen articles, but I would expect actually these to start seeing this stipend come to people's bank accounts this week or next week. All right. So saving and investing, as we get into some of this conversation and just how the market actually functions, there's a few questions that are important to know. What's the goal of the dollars you're investing? What's your risk tolerance? And that's, something that advisors a lot of times help people figure out. And there's even online worksheets to help figure that out. And what's your time horizon? These are all really important. And I would say the biggest one on here that people just to think about is really focus on the goal and your time horizon. Because the longer that you have to invest dollars, the more aggressive typically you should be with that account. If you know you're not going to touch that account for 20 or 30 years, which many times are just retirement accounts for people, then it's usually in your best interest to be a little bit more aggressive and try and earn a better rate of return. We'll actually get into this. Flip to something. I'm going to come back. With any account that you have money in, they're within a portfolio, or what are called fixed income or equities. Equities, just think of that as stocks, any type of stock, or mutual fund, or not mutual funds, but stock, if you own stock in a company. Fixed income would be bonds. So it's not, you're not owning a company. Think of equities as aggressive, fixed income or bonds as safe. You're not going to make as much with fixed income, but you're not going to lose as much. On the flip side with equities. So in any account, the more equities that you have inside of that account, the more risk that you're taking at a given time. But you would also hope the more return long-term you would actually experience with that account. It's not a linear line. So I always tell people to be cognizant of that. You don't have to be overly aggressive. But if you have a good amount of time horizon on an account, you don't want to be too conservative with it, or you'll miss out on market growth. But just on a basic level, how aggressive you should be with any account is really determined by your time horizon. Any questions on any of that? Okay. So it's the same thing that we just talked about, but depending on your time horizon, there are different places to put money. And I think I had a slide earlier, but short term, obviously, you want to have a good emergency fund. You want to make sure that you have typically 6 months of your expenses and saved up. So if something happened, you lost your income, you lost your job, you have money to fall back on. If you have a house and a mortgage and stuff like that, sometimes more, just because more things can happen with a home, and kids obviously can increase that number too. But you don't need to be overly aggressive with those short-term dollars. They're meant to be there. It's okay if they don't grow a lot. So really that checking accounts, savings accounts, sometimes money market accounts, but that's really where you want to keep short-term dollars. Long-term dollars, that's going to be retirement accounts. So 401ks, 403bs, IRAs, Roth IRAs, annuities, all those fall into long-term buckets. And if anyone has questions on any of those terms I just threw out there, toss them at me or put them in the question box. And then there's also places to put midterm dollars of, hey, I want to save money, but I don't need this money in the next couple of years. Where can we put it that may not be overly aggressive, but I'll certainly earn more than my checking account? And that's what a good financial plan should really look like. You should have different buckets building to make sure that depending on what happens, because it's hard to know exactly what is going to happen or what you're going to need in 10 or 15 years, but you're setting yourself up to have options. That's a lot of what planning is, making sure that you have the right option at the right time. Okay. I put this slide in here real quick just because I think this is super helpful to look at and just to gain some perspective, because I get questions about how the stock market works. So the S&P is just basically a metric that tracks all these companies. It's a really good tracking tool of what the market is doing. And a lot of times if you're watching CNN, Fox, whatever, at the bottom, these are what it's showing, like how is the S&P doing and all these other metrics. And you can see what it's done since 1900 to 2000. This ends in 2010. But it's not a linear line. And it never will be a linear line, because a lot of things can throw off the market, either real things or artificial things. We're in a day of age where a tweet can actually really affect someone's account if it's heavily associated with one specific stock or something like that. But what you can see over time is it's going up and down. There are some big spikes and some big downturns, but typically the biggest spikes happen at the biggest downturns. So if you look at the Great Depression, obviously that was a huge downturn, but what happened right after? It was some of the most explosive growth that they had seen. Same you can look at all of these different areas. The global financial crisis in 2008, 2009, some of us experienced that. Some of us were not actually investing yet and experiencing that. But what happened after that? We've had explosive growth in the market between then and now. So the market is cyclical, but what the biggest point on here that I try and make and want people to focus on is the only way, typically, like if you have a well-structured account, like investment account, the only way you lose money technically is if you pull money when the account is down. That's where people make the biggest mistake. And so let's take the 2008, 2009, the market's going down, people are getting nervous, which is totally natural, and it makes us make emotional decisions. For people who pulled out their money and put it into just like cash or had it in a checking account or not invested, they did not get to partake in any of this explosive growth. So they actually, if their account went down 30%, and they took their money out of the market, and they did lose 30%. If they kept it in there, typically in most balanced accounts, typically even in that, like which is considered one of the worst recessions in history, even if you left your money in your account, it all got back to where it was and rebounded within 18 months. So sometimes just having some perspective in turbulent times like this is important. Now, coronavirus is a little bit different because there's a little bit more unknown, but it typically, if you just look at this history of the market, if you're playing a long-term strategy, staying in the market is is a good idea, because you just don't know when that explosive growth is going to come back. Any questions on any of that, or anything on this slide here?
Hey, Lewis, it's Jeremy. I actually have a quick question that maybe you can help me with.
Yeah.
So my company allows stock purchase plans, and what they do is they do offering periods that are about 2 months, and they purchase at the lowest point of which the stock hits, and then at a 15% discount off of that. So their next purchasing offering period starts on April 15th, then it will go for 2 months or so. Do you think, so that comes straight out of my paycheck for whatever I'm allowed to, whatever I'm able to allocate towards it. Do you think it would be a good time on that April 15th to possibly increase what that allocation is?
Potentially. I could talk to you offline to give you, a little bit more insight, but it potentially might, and you can typically do up to 10% in those stock purchase plans. Each plan works a little different. So if you want to talk offline, I can help you look at it. But yeah, obviously if you can buy at a discount and that they discount that for you as well, it may be a good opportunity.
Okay. Thank you.
Any other questions? Anything else? Keep going here. Okay. Now the fun part, what everybody wants to talk about typically, insurance. That was mostly a joke, but it is a hot topic right now. The most often thing I see in financial planning that people forget is to actually make sure they have the right insurance in place. Typically people know you should have health insurance, but life and disability insurance are extremely important to have as well. And I think more so people just, we don't get a lot of education on this in school or anywhere else in our life. So people don't know typically what their options are. Disability insurance, actually, I'm going to start there. So disability insurance, what that means is if you became sick, injured, disabled, anything took you out of work temporarily or permanently, that type of insurance plan would pay you your income or replace your income like you were still working. It doesn't cover getting laid off, but it covers any type of sickness or illness or anything that prevents you from working partially or wholly. A lot of employers will offer some amount of coverage for their employees. Typically, it's either 50 or 60%. For any business owners on the call, the reason is because that's what the business owner can deduct as a business expense. Because of that, it makes it a taxable benefit for employees. So it's still a good benefit, but what happens is if someone actually became sick, injured, disabled, and they were on claim and that policy paid out, it's a taxable benefit. So the benefit typically ends up being about half of what their paycheck previously was. That's an issue. And obviously it's something you hope doesn't happen. But there's a lot of crazy data and analytics and statistics. This is from the Social Security Disability Program from 2018, but 1 in 4 people become disabled, and what they consider disabled is they're out of work for more than 3 months, so past 90 days. That happens to 1 in 4 people before they retire. Disability insurance is overlooked, but it's, in my opinion, a really, really important part to have in your financial plan. If you work for an employer that has a plan for you, typically what a lot of people will do is supplement the difference in that. So they offer 50%, and you can get your own plan that covers the other 50%. It's usually a pretty inexpensive plan, but then you actually get to lock in some at your age and health that covers like half of your income, and you get to take that with you if you leave your employers, and you keep it even if your health changed for some reason. So there's value in just owning some of your own coverage, even if your group coverage gives you some coverage. For self-employed individuals, this is still important, and you can get this on your own. You can also offer for employees, but even if you're just a sole prop or you're an independent contractor or just like a small business owner, you can get this coverage for yourself. And they just will typically look at like 3 years of tax returns and base how much they'll give you off of that 3-year rolling average. That's just kind of the basics on disability insurance, but typically what we, we'll really try and help look at people's actual like policy that they have, if they have a group policy, and see if there are gaps or anything that makes sense to look at. And then if there are any business owners on the call, we can certainly talk about like group plans, how you offer that for employees from the other side as well. Any questions on disability insurance? There's two different types too, or lengths. There's short and long term. Short term typically covers you from 1 to 90 days. Long term from day 90 till you retire, age 65. You can buy insurance for both of them. I typically think that long-term disability insurance is a more important piece to cover. If we can have a good emergency fund saved, then we may be able to self-insure, a short-term or a temporary injury. Long-term disability insurance is just smart planning to have, because it doesn't it's cheap. It's really inexpensive to just put that risk on an insurance company and hope you never use it. So this is just what we talked about. Most group plans have about 60% covered, and a lot of people fill the gap of whatever is not covered through their employer. Okay, life insurance. These are both very interesting topics right now because I do a lot of work with Northwestern Mutual, but I work with a lot of other insurance companies too. I'm technically an independent advisor. And insurance companies are trying to figure out how to still offer policies and issue new policies with what's going on. So this has been, I think I've had more calls on life insurance, on just getting life insurance over the last 2 or 3 weeks, certainly than I've had in the last 7 years I've been in this career. But it's just been a topic that people are interested in. So what life insurance is, it's really meant to help if something happened, help replace whatever someone in their financial plan wants it to replace. And that's a different number for everybody. So there's not a right or wrong answer. There's not a flat number based on your income. There's general rules of thumb. But here, some of the things that people are worried about are mortgage payments, childcare, college funds for the future, outstanding any loan payments, supporting kids or family. The biggest piece of life insurance that I personally that I look at is income replacement. And that's what people forget. So if something, God forbid, happened to one spouse, let's just say a household has 2 incomes and they're the exact same income. If something happens to one spouse, the household income does not go down in half. So typically what people are trying to accomplish is replacing that household income. So the household income stays roughly the same, at least until kids are older and independent and not financially, or they're financially independent. So sometimes for people who have young kids around, owning 10, even sometimes 15 times their income in life insurance is what we see people do, because it's meant to be spread out over potentially 15, 20, 30 years. Your life insurance need can go down over time. There's different estate planning uses for it in the future, but there's your insurance need changes throughout your life. There's 2 different types of life insurance and how you can go about doing it. So the first is called term life insurance, and that's what I think probably most people are familiar with. The second is called permanent life insurance, or sometimes it's called whole life insurance. So think of those as 2 separate categories. Term life insurance is like you're renting an insurance policy. It's like car insurance in a way. We can choose how much we want it to cover. So hypothetically, let's say we want $1 million of life insurance. The cost is based on your age and health of when you start that plan. And you can choose the term of how long it lasts, 20, 10, 20, 30 years. You can choose how long it lasts. And then once that policy expires, then policy's gone and you don't recoup any money. Typically, policy is just done. So it's kind of a use it or lose it type of benefit. Upside of term insurance, it's really, really inexpensive, especially when you're young. So there's a big advantage of locking that in when you're young and healthy. Downside is most people outlive it. I think there's a statistic, I think only like 5 to 6%, and don't quote me on this, but of term policies pay out. they're really important to have in case something happens, but they're obviously, ideally, they expire. The other kind is called whole life insurance or permanent insurance. They're kind of interchangeable terms. That type of life insurance has the insurance component. You can still choose whatever that amount is. But there's a couple key differences. One of them, it's called a whole life policy because it lasts your whole life. It doesn't expire. At some point, that will go to somebody. And any life insurance policy in either situation, term or whole life, or tax-free death benefits. Whole life policies also have a component inside of them that build money, and they call it accumulated or cash value, but it basically builds money in a savings tool that grows and compounds and actually earns interest over time as well. And there's sometimes people utilize that as a savings tool in addition to a life insurance policy because of some of the tax benefits and safety of some of the dollars. It's not, I'm not saying it's a good or bad place to put money or have insurance, but it just depends on what people are trying to accomplish. If there's some amount of insurance they want to last forever, term insurance doesn't work for that. So they're, helping people figure out, first thing is like, how much coverage should you have? That's the first question. And then the second is how does it make sense to structure it based on a financial situation? Is it all term insurance? Is it all permanent insurance? Is it a combination? Again, it's really depends on the situation and the actual client or clients that we're working with. What questions does anyone have on life insurance? Before you keep going here. The one thing I will mention that's kind of weird about life insurance, typically it requires you to go take a medical exam and do some type of blood work or something if you're applying for enough insurance. There's some requirements it requires. Some companies right now are dropping those because they know that people don't want to go get their blood work done or have a nurse come and do it at their home. So some companies are allowing you to actually apply for some of these policies without having to do any of that, with trying to just use the medical records. So if that's something people are interested in, feel free to connect with me offline. But it's an interesting time. Some companies are like actually stopped selling life insurance to people over 65. And things are changing a lot in that market and industry. So that's why a lot of people have been talking about it. And just I've had a lot of questions about it. I had this question come up previously, like, I still want to maybe, during these times, if you had income change or there's just financial changes in your life, how can I still help in the community or like even pay dues? I would encourage you, if like work with whoever, that is, if it's a synagogue, if it's any other foundation or something you're a part of, and you need to put things on pause for a second, or a lot of these places are willing to work with you. So I'd encourage you to talk to them. And obviously, in terms of giving back, there's other ways to do it besides financially. So I would encourage you to, if those are issues that people are having during these like financial kind of crisis times, go talk with them, because a lot of times they can help structure a payment plan for you that might be a little bit different. Payments protection program. So quickly, this applies more to business owners, and I can get into this more specifically, but basically they just released a $350 billion plan that will give loans to business owners with fewer than 500 employers. And a portion of that loan can be totally forgiven under certain circumstances. They actually can get up to $10 million in loans. So if, for what they're really trying to do is have people keep payroll and make sure to keep businesses are going. So they're trying to get people or businesses loans as quick as possible at the lowest interest rate and see how much of it they can forgive. So I won't get into all of that, but they calculate it based off of payroll and business expenses from the previous year. But applications have started for that already. So and there's more that's kind of they're updating throughout, as things are changing. So if you're a business owner and want to talk more about that offline, let me know.
Hey, Louis, how does that apply to nonprofits?
It's a great question. They're doing a similar thing for I think it's the same for nonprofits. I can check, and I can actually send you. I've got a whole piece that gets into all the weeds, but I think nonprofits can do something very similar.
So they're
Yes.
eligible to apply for this as well.
Yes.
Yep. And so nonprofits certainly. An example on this. So for people who are self-employed, like I'm technically self-employed, but like let's say if anyone is listening to this and they're self-employed and they have maybe they have 1 or 2 employees right now, and business is really affected. What you can do is you can apply for this loan. But they'll go look at whatever you paid your employee or employees over 12 months for 2019. Take like a monthly average, and they'll give you a loan for 2.5 months of that amount. And if that is used like as a loan, essentially, and they're giving really low interest rates on these loans, and if you use it for employee, like if you use it for the certain expenses, and payroll is one of them, it can all be forgiven if it's within 8 weeks right now. They're still making changes on that. But for some people, if you're trying to figure out how to keep employees, this plan might allow you to it would pay your payroll potentially for a couple months. So this is one that I've seen help a lot of small businesses, or just like even individuals, independent contractors. So
Would you be then subject to some sort of audit at the end of this, just to make sure that you are complying with that?
That's where there's a little bit of gray area. But yes, it lists specifically, and I can pull it up after if you want, but it lists specifically what it can be used for. But it makes it, every business owner I know right now that qualifies for this, they're taking advantage of this right now. Because worst case scenario, I mean, these loans that they're offering right now are at such low interest rates that even if there's some that you have in excess that you don't use past that 8-week period, and you need to pay it back or not pay it back, I mean, you could just pay it all back at that point and you're still not out any money. But it's a really, really good plan for business owners right now.
And if you get your loan forgiven, does the interest get forgiven too, or do you still owe that?
I have to check on that. I'm not positive. Let me, who asked that on here? It was
That was Genevieve.
Genevieve? Okay. I can get back to you on that, but
Thanks.
I believe so, but I need to check on that. Okay. Anything else on the payment protection program? So just, I mean, recapping, I know we went through a ton of stuff. What I would encourage people to do is, like, if you haven't really sat down and built out a financial plan, obviously I'm a big fan of working with a financial advisor to help think through all of these things comprehensively and help figure out what you may not be thinking about. But even if you're just doing it individually with your family, it's a good time to have this conversation. And they're hard conversations to have. And that's, if it's a hard conversation, it's very common to have people help facilitate these conversations. Financial advisors obviously do it all the time. But talking about a lot of these things, like how much you're spending, saving, like what to do with insurance, they're not fun conversations to come home and have at night typically, but they're important and you have to have them. So I would just encourage you to, if you haven't thought about some of this stuff, to really sit down and do them. And certainly if anyone wants to connect after the fact, I will do some Q&A, but so I'm a financial advisor. My office is downtown in Minneapolis here in the Capella Tower. Obviously we're doing everything remote and virtual, and it hasn't changed business. Business has kind of gone on as usual. And we don't charge a fee typically to actually have a first initial meeting with clients. So if anyone's interested after, just in connecting and learning more, just to have a quick conversation on anything to see if there's stuff that we might be able to help you with, shoot me an email, shoot me a call or a direct message from this. Hopefully this was helpful. If you guys have questions after the fact that you think of, or people who are watching this after, don't hesitate to reach out. But any other Q&A or any other questions that people have here before we wrap up? It's got to be something.
Hey, Lewis, great job. You're doing it. I know that we've helped J-Link in the past for a ton of different events. So this is Josh Awin. So I just thought I'd, tip my hat and say thanks for jumping on board with this. And Genevieve, thank you for facilitating all this. I guess the big question I would have is how do you look at like the big dips that are happening? Obviously, it is that idea that, a ton of stuff is on sale right now, quote unquote, as far as, buying back into the market. And if you have any money left, which is probably not a lot of people, but is there something to be said about, just bite your tongue and follow that graph that you said, and the history does bear out that this will all come back, because this isn't technically even the correction that everyone was talking about. This was literally a disease caused a global crisis. So does that make sense? Or do you think there's more dips to come, I guess is my other question.
Yeah, it's a great question. And I'd probably be very famous if I could give you an exact answer to that question. But the reality is, what most financial advisors would coach you to do is learn from history. We know that like this is a little unprecedented, but there have been other outbreaks and stuff like this that have happened before. I would say trust history. Will the market go farther down? It's possible. It depends on what you read, but it could go down further. But what I also help people think about is don't try and think about it in the sense of that you're trying to perfectly time and put money in at the very bottom of the market, because it's highly unlikely that will be you or any financial advisor. Even if you're putting money in the market right now, you're buying at discount typically. And just putting things into perspective too, over the last 5-10 years, like people are just, like last year, the market did so well. Market goes up 20-25% in 1 year. Now it's down 20. Have a little perspective too here. Like, it's not like we're totally down. We did have a lot of growth over the last 9 years. So at some point recessions happen, but it's cyclical. So I would tell you, don't necessarily try and time the market. But if you have funds, it's a good time to put money in. And that doesn't necessarily mean that you have to go and pick individual stocks and try and guess exactly what industries. Even purchasing like a well-balanced mutual fund that has a lot of stuff inside of it, like hundreds and hundreds of company stock inside of it. Those do well over growth periods as well, and don't give you as much risk with specific companies. So, but thanks for the question, and thanks for I've enjoyed working with J-Link, and I'm sure there will be more stuff like this in the future. Any other questions?
Lewis, we do have a question from Amy in the comments. What are some of the most common questions or concerns you're hearing from people?
It's a great question. I would say there's a couple. The one that I actually did not anticipate as much, but the question lately I've been getting more so is more on the insurance side of things, and if people can still get and apply for both life and disability insurance. And because they could just, it's different than just going and getting health insurance, because these are companies that could just stop selling it. I'm not saying they're going to, but that's what I've just been getting the most questions about is like, do I have enough insurance? Like, should we want to review our life insurance or disability insurance? The second question is actually Josh's question too. So like, what do we do in the stock market? Like, I have an account. Should I make changes in my retirement account or any of these accounts? And typically, if it's a retirement account, typically the answer is no. If it's structured well already. The third biggest one that I get I think, especially for younger people, is should I do traditional or Roth? And I don't know if I didn't put that in here anywhere, but basically that just means how a retirement account is taxed. So with an IRA and a Roth IRA, you can choose if you pay your taxes now or later. A traditional IRA or a traditional 401k, when you put money in, you get to take a tax deduction from anything. You get to take a tax deduction from whatever you put in. Then the money grows tax deferred, but then when you take money out or in retirement, it's all taxable. If you do it as a Roth IRA, you don't take the deductions. You don't like, oh, it's taxable. You just don't take a deduction. The money grows tax free, and then it's all tax free when you actually take it out in retirement. Most employer plans now, 401k and 403b plans, allow you to choose if you're contributing as traditional or Roth. So like whatever percentage you choose, you can choose if it's before or after taxes. So there's a lot of, especially for younger clients, I mean, having tax-free money in retirement, there's some value for having tax-free versus taxable money in retirement. The other thing I would say is if people have like IRAs, Roth IRAs, stuff like that, you can actually convert. This is getting a little bit in the weeds, but if it applies to someone, it might be helpful. You can convert money from a traditional IRA to a Roth IRA, or from a traditional retirement account to a Roth retirement account. You just have to pay the taxes in that given year on that amount. So typically when the market's low, it's actually or if you're in a lower tax bracket in a given year, it's a good time to convert some of that to the Roth bucket and make it tax-free in the future. So there's some tax strategies right now, a lot that are happening that people take advantage of when the market's low as well. It's kind of a long answer, but.
So Lewis, for somebody who has never done any formal savings or investments, is now an okay time to start doing that?
That was a great time. I think, yeah, like I said before, I think the hardest part sometimes is just getting started, especially if you don't have the knowledge base of what to do. Like if you have a retirement plan at work, that's great. You can participate in that. You can always start one outside of your employer too. Many people have both, but I would encourage you, if you can save money and have the ability to save money, it's certainly a good time to. But consistently saving money over time is what, when I see people who have done well in retirement savings and retirement planning, it's because they've stuck to saving a certain percentage of their income over time and strategically made sure they're putting it in the right buckets. But for new investors, if you need help or you have questions, go ask someone. You can meet with financial advisors or just people that might have some knowledge on it, and it doesn't cost anything to do that typically. So I would say it's a great time to get started. Anything else?
Are there certain indices or stocks that you're seeing that are actually like really good value items right now historically? Like you're saying, you play history, like Delta Airlines obviously is one, or is there like certain sectors like energy or those type of sectors to just keep an eye on? Obviously, you're never going to play the bottom like you said, but
Yep.
Stuff is low right now, so maybe it's worth to pick up.
Yeah, there certainly are. I compliantly can't give you recommendations on anything especially on this call, but
publishing to the internet, you can't give advice, financial advice.
Trying to be as general as possible here.
Yeah, right.
But yeah, I mean, a lot of like long term. I still try think long term on a lot of this. If you have a good plan that's structured long term, some of this like when I picked a specific stock or when I did some of that might matter. But it matters more that you're consistently saving the right amount over time, versus like trying to time. I know this is a time when it feels like I can buy a discount and I can try and strategically do that. I'm not saying that's a bad thing, but I would also focus on just making sure that, like, especially after this, that the portfolio and stuff that you have are well balanced for a long-term strategy versus just a short-term one. Maybe not the answer you wanted, but
No, I get it. But yeah, I mean, at the end of the day, talk to your financial advisor or get with someone to set up a plan is essentially what you're saying.
I always think that's a smart idea. I'm a little biased, but
Perfect.
Yeah.
I'm crushed to hear that I'm probably not going to pull off a big short.
Maybe not, but you start saving money, and that's a win too. I mean, the best time to start saving was always yesterday. There's always reasons that can prevent you from waiting and things that you want to buy today, but with how compounding interest works, the earlier that you can get money, growing and working for you, the better it is long term, the less you actually have to save. So starting early is certainly important. It's probably one of the most important parts of investing.
We have one more question from the comments. A question I hear from a lot of people, our commenter says, is, do you need to have X amount of money to meet with a financial advisor? So is there a minimum to meet with someone?
That's a great question. It depends on the advisor. So and kind of what type of planning. So most, typically how we structure it, no, there's not a certain amount you have to make or income level. If someone is interested in doing planning, there's typically stuff that we can help them with, even if they don't have a lump sum of money. Like I said, sometimes people are looking to just get something small started, like a Roth IRA, or a life insurance policy, disability insurance. So just because people don't have a ton saved up yet, that is not a reason that you cannot meet with a financial advisor. Typically, the people I'm looking to meet and build relationships long-term with are people that, are interested in building a long-term plan and a long-term relationship and want to do that. So even if someone doesn't have a certain amount of income or assets, that doesn't mean they can't meet with someone. And but some advisors will have certain minimums and stuff like that. And we can always, if we can always, refer to someone else who might be taking on different types of clients too. So no is the answer. Anything else? Awesome. Well, thanks for having me. I know I've met most of you. Well, I actually can't even see who's all on the live stream now, but I encourage you guys to just, especially during some of these times, like, don't make emotional decisions with some of your money. Make sure you're thinking long term and thinking about what typically happens, as opposed to making emotional decisions that could affect you later. And if you want to touch base on any of this specifically, or just have more questions about what I do or anything specific, feel free to connect with me. I think my info is on here, but obviously it's enough places on social media. You could probably just Google my name at this point as well. So thanks for having me, and thanks for everyone who attended.
Thank you so much, Lewis. And we will post your information in the event in JLink. And this video is on Facebook. It's going to wrap up recording live in a second here when we close out, and it's going to be available in perpetuity. So if you know anyone who could benefit from this, or someone who wanted to attend but couldn't, you can direct them to TCG Folks' Facebook page to watch it later. All right. You're the best, Lewis. Thank you.
Thanks, guys. Take care.